Well, good morning and welcome back to the ROS Media channel. My name's Andy and I'm here with my good friend Ian Clifford, who is the founder of the Republic of Old Souls and president here. And also today, we're going to be digging into some real technical stuff. So if you like technical, this is definitely for you. We are going to be covering a treatise that Ian has put together, all to do with signature credit tax redirection. There's been some misunderstandings, I feel, and I'm sure Ian feels the same, when it comes to what is it are you actually recouping when it comes to signature credit. And a lot of that has stemmed from phrases like bank payment recoupments and other phrases similar to that. But the reality is you're not recouping the securities themselves. You're recouping the taxes paid or redirecting the taxes paid on those securities and the use of them. So today we're going to dig into this treatise. There are 12 sections to this. This is going to cover everything front to back, including the Clifford Protocol, including all of the IRS's legislation and terminology and revenue codes. There's a lot of data that we're going to be going through today, but I'm excited to cover this. And hopefully we can help you make some sense of just how in-depth, how robust, and how legitimate the Clifford Protocol and signature credit tax redirection actually is. So, Ian, great to have you with us today. We've got 12 sections to go through, so let's dig in. The first section, and this is all based on your treatise document. If anybody wants to see that, it will be on ecclesialaw.is. You'll be able to read it there. Certainly one of the more robust, more technical documents that Ian's produced up to this point. The first section we're going to cover is the jurisdictional foundation of modern credit. Let's start right at the beginning, because if we look at the foundational architecture of this, most people believe that they use money to pay for things. But your treatise points back to June 5th, 1933, and House Joint Resolution 192. What actually happened to the global financial system when the gold standard was removed? And how did that establish a mandatory system of discharging obligations rather than actually paying for them?
Well, we went from money of substance to money of account, and money of substance was backed by gold. So you had a reserve of gold, and then you had notes that were equivalent to the value of the gold. So you couldn't expand the money supply unless you could store more gold. So that was a problem for the bankers, because they couldn't get enough gold in reserve to expand the money supply. And they wanted to expand the money supply so that they could control the world population with, using the money system to do it. So they had to come off the gold standard. But they couldn't come off, they couldn't just announce that they were coming off the gold standard. They had to create a crisis. And the crisis was the Great Depression. And in the middle of the Great Depression, of course, people that are really badly affected by that, when the Federal Reserve Act came out some years before, which was a precursor to the House Joint Resolution 192 that came about in 1933 in June. It's actually tabled in March, I think it was, but it came about in June. And by then, the United States population was desperate for a solution. And the solution was to withdraw gold and replace it with human energy. They didn't announce that, of course. I don't think many people would have gone along with that if they'd actually known what was going on. So money of substance started to go away in June of 1933. So that two significant things happened. Gold was withdrawn, and the whole monopoly board system, which is a worldwide trust, went into permanent bankruptcy. which meant that the United States Treasury could operate as the bankruptcy trustee for the creditors. Well, the original creditors were the banking cabal, the top bankers in the world, the banking families that basically run this system, that are shareholders in the Federal Reserve, because it's a private organization. It's not a central bank. Many people believe that because it's called the Federal Reserve, that it's actually federal, but it isn't. It's a private corporation where all the top banking families have shares in it. So it's kind of their system. They put the United States Treasury into operation as the bankruptcy trustee of the entire World Monopoly Board, this trust, and then took a mortgage out over everything on the Monopoly Board, all the land or the property or the assets suddenly were hocked, or they were mortgaged to support the bankruptcy. And that included, critically, the birth certificate registrations of birth certificates that had become registered securities, and that enabled the system to operate this usufruct system, which is basically it's a slavery model where everything on the Monopoly Board is pledged to the original creditors, including the birth certificate securities, which many people believe they can cash in, but they can't because they don't have legal title to them. And that enabled the whole board to be basically floated on the transference of human energy. So that's where your money of account comes in. Now you've got human energy that can be put onto the Monopoly Board through the birth certificate construct, which is the straw man, as a banker, and it can be then created into currency by the bankers operating as nominees for the true creditors, which are the living men and women, but they can't step on the Monopoly Board itself. So you've got this problem reaction solution. They create the problem, which is the Great Depression. The reaction was to offer a new system, but confiscate the gold at the same time as part of that new system, and then basically bring out the Federal Reserve notes, which the FRNs, as they're often called, which are obligations of the United States. So everyone's using them as if they're money, but all they are really is ledger entries, obligations of the United States. And the collateral that underpins all of that is predominantly the energy of the people. It's 97% of it is the energy of the people, which put their energy on the board every time they engage in a banking transaction, a bank payment, a mortgage, a loan, a credit card, or any other kind of banking transaction. That creates the trigger point for it, for adding into the existing debt another debt, which will be a promise to pay in the future as a new transaction, which creates new debt on the board, on the Monopoly Board, and that was all made possible, from June 1933. It didn't fully come into force until 1944, and then it was taken to the next level in the Bretton Woods Accord, and then there was still some gold backing money up until 1973, and then it completely came off of the no gold at all from 1973 onwards, and it became 100% backed by human energy. So it took from 1933 to 1973 for it to happen, and it gradually stepped away from money of substance into money of account, which is what we have now. And of course, since 1973, it's all been money of account. It's all been ledgers. And that's the brief plotted history of it. It actually started a long time before that. If you go into all the way back, you go to 1882. That's when the Bills of Exchange Act came out, which made it possible much later on for the person, the straw man, the citizen, to be able to issue negotiable instruments, because it's embedded in the Bills of Exchange Act of 1882. That's what really made it possible. So, this was planned out for a long time. It didn't all happen quickly. It happened from 1882 to 1973. So, nearly 100 years went by whilst they're bringing in this new system until it's completely in, and there is no other system. It went across nearly 100-year span before it was fully introduced. And they do that because they don't really want people to notice. Yeah. So they do it in steps. They don't bring it all in one go, because too many people might realize what's going on. So they bring it in steps and hope people don't realize. And that's what I've noticed in many areas of the control system. It doesn't all happen in one round. It's in several rounds with big gaps in between, and people don't tend to notice because they get wrapped up in other things. And it's only when you start doing retrospective research you can join all these dots together. But when they're happening, you don't see them, of course, because there's always something else going on that is distracting everybody away from what they're really doing. So it's like a magician's trick. Whilst they're hiding their cards up their sleeve in their right hand, you're watching the left hand doing something else, and that gives them the ability to hide the card up the sleeve, in the right hand. So that's what they do all the time, and that's what they've done here without any doubt at all, for me.
So moving on, section number 2, you mentioned a moment ago about new credit being issued onto the board. So I want to talk about that, because I think this is where people's understanding of sort of standard banking falls apart, basically. It certainly did for me. Could you walk us through how commercial banks create money ex nihilo, out of nothing, and how that's not just hearsay, but it's backed up by, for example, the empirical work of Professor Richard Werner, even the official admissions of the Bank of England themselves? So what's all that about?
Well, I think if you ask people, where does the money come from? It's not really a question that most people have ever considered. They just take it for granted that, somebody you get paid or you make a profit on something and you get some digits in your account, but you never really ask where they come from. And the government talks about, deficits, and they're going to raise taxes to finance this and that, or they're going to inject quantitative easing into the economy to stimulate it, and nobody ever says, well, hold on a minute, where did you get this money from? You're going to inject quantitative easing into the market. Well, where does it come from? Is somebody lending you that money, or are you just waving a magic wand and creating, which is pretty much what they do? So ex nihilo credit creation had to come in with the bankruptcy of the United States, because money of account is just ledgers. So you want to create a simultaneous, and this is what it will blow a lot of people's minds. What they're doing is they're creating a debt and a credit at the same time, so that one balances the other out. So when you make when you create a mortgage, for example, you sign for the mortgage, the energy is the asset which credits the board, and then the bankers, acting as nominees, create a matching liability simultaneously, and the liability stays on the board, so that everything on the monopoly board, this world trust, is all debt, but the asset is energy. It doesn't have substance. You can't pick it up. You can't put it in your safe because it's human energy. So the asset is a deposit which doesn't have substance, And the matching liability on the other side of the balance sheet is what stays on the monopoly board as world debt. That's where your money comes from. Of course, if everything was backed by gold, they couldn't run this system because the deposit would have to be backed by gold. Well, human energy isn't backed by gold, it's human energy. So it's a perfect slavery system where you can fool the people into believing that the banks have got some money to lend, because most of these things are loan origination. And the people don't realize that they're transferring the asset onto the board, which then gets abandoned, leaving the debt, which is the equivalent of the asset, because it's two sides of a balance sheet, leaving the debt as what people call money, which is why it's all negative, because it's all debt based. So the world debt clock is a negative figure. It's not a positive figure. And the creditors on the other side of the world debt clock is the human energy, is the creditors being the living men and women who don't step on the monopoly board. They can't. Their energy's been abandoned on the board. It's being used by the bankers. It's being used by the nominees, and that's why they pay taxes for the use of it. But you're not actually recouping the energy. You're recouping the taxes that are being paid on the energy, which perhaps we'll get back to. But yeah, so ex nihilo is the signature, is a deposit. I often say on my webinars, if you were at a dinner party with a load of bankers and you said, how do you guys lend money out? And they will all say, oh, it's easy. We take deposits and we lend them out. Well, they don't tell you what a deposit is. A deposit is a signature. It is a promise to pay in the future. It's not a transfer from somewhere else. It's just an energy transfer. It's not a transfer of money from another account. And that's where the phrase deposit is very confusing. There's a special deposit, which is actually a deposit of existing money. And then there is what the bankers use, which is just basically, they just call them deposits. But that is promises to pay. And you can open an account, and if you open an account and go to the bank and say, I want a special deposit account, they won't like giving it to you, because they have to actually reserve. They can't do the ex nihilo credit creation. They have to actually store, and as a custodian, the digits that you put in there, they can't touch them. They can't claim that they can't use them as their own under a special deposit account. They don't like giving those out much. So when you get a bank bail-in, for example, where the bank is in great difficulty, which is ridiculous because it should never get into great difficulty, but they like to create this image that banks can go bust so that people believe that the banks are taking a risk by lending money out. That's one of the reasons why some banks go bust, because it creates the perception of, oh my God, banks are taking this huge risk in lending people money for mortgages and loans and credit cards. And every now and again, a bank goes bust, and that kind of justifies the risk taking that the banks are allegedly playing with. But they're not, because no bank should ever go bankrupt because they can use ex nihilo credit creation. In fact, Barclays Bank did exactly this in 2008. Its balance sheet was very sick and it should have gone bust. So what did it do? It lent billions to the Saudi sovereign wealth fund. So the Saudi sovereign wealth fund said, I'll tell you what, how about this then? Or I think Barclays suggested it to the Saudi wealth fund, sovereign wealth fund. We need X billion. So if we lend it to you and you sign for the loan, therefore the Saudis are signing a loan which creates a deposit of X billion, and then the bank can lend the Saudis the same amount, ex nihilo, and then the Saudis can invest it in the bank. And if you have a look at the records, you'll see that the Barclays Bank was bailed out by a Saudi wealth fund, sovereign wealth fund, but it didn't cost them anything to do that, because all they did was get a loan and then use the loan to buy into the bank. And the bank said, well, you know, we've been rescued by this Saudi wealth fund, but it was just ex nihilo credit creation.
Amazing.
And all the banks any bank could have done the same. But they had to let some banks go bust, like Bear Stearns and Lehman Brothers and various other ones, because that creates the perception of banks are businesses, they take risks, therefore you've got to pay them interest, because if you don't, they might go bust.
Understood. So from a statutory perspective, if we think about, you spoke about Bills of Exchange Act, and you mentioned this in the Treatise report as well. Under Section 3 and Section 20 of that Act in 1882, how exactly does an individual's biological signature, how does that operate legally as a negotiable instrument, and that being the true sort of originating force of the credit, so that people can understand that from a legislative point of view?
Well, it's a contract, really. You've got a payor and a payee. So somebody's receiving a promise and somebody's giving it, and the two are basically in the act. You can't create a negotiable instrument unless there's a payor and a payee. It's a bit like a check. You know, you get you pay to the order of the payer and the payee relationship. It's a contract.
Yeah.
And the Bills of Exchange Act enabled the promise to pay, the promissory note, the negotiable instrument. It stems from there. It became, in the United States, it became UCC 3, Uniform Commercial Code 3, which is all to do with negotiable instruments, but actually it mirrors the Bills of Exchange Act of 1882. So it's just a contract. Somebody's promising to pay someone else in the future. And because the promisor is a person and the person is a banker, that promise can morph into a security, because the promisor, that the entity giving the promise, is a banker under the Bills of Exchange Act 1882. So you've basically got two bankers. You've got the promisor, which is promising to pay in the future, and then you've got the receiver of the promise, which is also a bank, taking that promise in and then being able to take that promise in as a deposit and then match it with a liability on the other side of the balance sheet. The liability stays on the balance sheet as a debt, and the promise goes away. It gets abandoned, and it's leaving the debt side, which is why everything on the monopoly board is a negative value.
So if we take this one step further then, because people are going to be sitting here thinking, well, you know, I never knew this. Nobody told me about this. Why doesn't the bank tell me about this? So, you know, if a commercial bank doesn't advance its own capital, but instead it records the borrower's signature, the so-called borrower's signature, or the person who creates the credit, and it records that as the asset. Can you explain how their securitization practices, in truth, I would say, obscure the true creator by moving or transferring these obligations into what you reference them as institutional omnibus accounts? So there's a lot of cloak and dagger going on here for obvious reasons, but how does that part of the process work? So once you know, I go into the bank and I sign for a mortgage, and as far as I'm aware, the money then lands in my account. I think it's real. I buy my house. I'm happy, but now I'm tied for 25 years paying the mortgage back plus interest. But if my signature's been securitized and then moved or transferred into one of these institutional omnibus accounts, what exactly is that part of the process?
Well, what they're doing is they're bundling up all of these promises, these deposits of energy. They're all individual transactions of some kind or another: bank payment, mortgage loan, credit card, other kinds of credit, transactional. And what they're doing is they're bundling all those up, and they have to transfer them to the investment banks, and they have to store them somewhere. And that's where the depository trust company comes in. So you've got the DTCC, and that the whole purpose of it is that they can disguise, they can come up with other names for these bundles of securities, these promises to pay in the future, which are all bundled together. They can then be disguised, wrapped in like a bond structure, so put into a collective, a portfolio, if you like, of securities of promises to pay in the future. And then they can give them a new name, give that portfolio a name, which is nothing similar to the investment bank that's actually using that portfolio or bundle of securities. The bank will pay taxes for the use of it, but it won't say, Morgan Stanley tax payment for the use of this bundle of securities. It will pay tax on the Morgan Stanley 945 tax module under a name which has got nothing to do with Morgan Stanley.
Right.
So when you look at the 945 tax module, it won't say Morgan Stanley tax module. It will have some other name because it's been disguised at the depository trust company. So they'll be paying taxes under a completely different name, which makes it more difficult to find out what's going on, because you can't really. It's a bit opaque. It's again like a magician's trick. You're looking on in one area, and it's actually all going on in the other area. You're not looking over there. You're looking at Morgan Stanley's tax payments, but actually what's going on is they've got another tax module which is called something else, a street name, just a name that's been created by and registered within the depository trust company, which is holding trillions of dollars of securities. Quite extraordinary.
Well, if you're watching this, I hope you're getting a little bit annoyed by now, because you should be. So let's talk a little bit more about the actual architecture of this, but also more importantly, the Clifford Protocol. So the mathematics behind reclaiming this tax that they're paying on our credit energy. Again, there's a lot of documentation that you refer to. There's a lot of sort of internal revenue coding, the IRC codes that you refer to, one of which is IRC 1273, to do with something called original issue discount, or OID. And you talk about, and this for me, this was difficult for me to wrap my head around. So it's going to be hard for other people to wrap their head around. So however you can simplify this, Ian, that would be great. But according to that IRC code, original issue discount represents the excess of a debt instrument's redemption price over its initial issue price. But why is the baseline initial issue price mathematically established at 0 at the moment of signing? If these are securities that the bank are selling on to the investment banks, why does it start at 0?
Well, at the creation of, the transfer of the energy goes on as a deposit. It doesn't have a value because there is no value to the energy at the outset. But there is a high future value of the debt. It's actually a low future value because it's lower. You're everything's inverted, but let's just call it a high future value. It might be easier to comprehend it. So you can't value human energy. It doesn't have a value. You're not exchanging like bartering. There is no barter going on. what's going on is ex nihilo, is out of nothing. That's what it means. It's sort of Latin for out of nothing. So when you make that promise to pay, the energy transfers through the birth certificate construct as the banker under the Bills of Exchange at 1882 at zero, because you can't value it. There's no way of valuing what that energy is worth until it's converted into a debt. And when it's converted into a debt, now you can start valuing its future value, which is what the banks are doing. They're calculating what that debt can be used for in the system, in the banking system, which enables them to hypothecate it. So they can use it to expand even further. They can grow the money supply even further with this hypothecation model, and they can expand the money supply basically, and they can use it to create more interest payments, which is, the usury part of the whole system. They can then justify charging interest, and it is the interest on the debt which they're not lending. So that's the slavery part. The banks aren't lending you their money, so they don't deserve to get interest, but they charge interest because they appear to lend money, and it's the interest that the investment banks are paying. It's cash flows of interest. Just like if I think we used this example before. If you've got a very successful business and you want to sell it, the investor in your business will be looking at how reliable is the income, the profits that are coming in every year. Are they reliable, or are they, are they here today, gone tomorrow? If they're reliable, then an investor will pay you a multiple of the annual profit to buy the business. And what the investment banks are doing is they're paying a multiple of the interest that is going to be paid on the debt by the slaves, which is why it's trading human energy, because the energy comes from the men and women, the living souls, transferred to the monopoly board, which is artificial, created into debt, interest then charged back, which makes the living men and women go out to work or run a business, trade something or other to generate cash flow, so that they can pay the interest on the debt. And where most people in the modern economy have got some kind of debt, there aren't that many people who go through their journey on the monopoly board with no debt, because it's really difficult. How do you get started if you don't get into debt? You get a mortgage, a loan, or a credit card. Very few people save up to buy a house now. They'd be saving up for 30 years. By the time they've saved up, they're probably too old to have the family they were planning to have. So people get a mortgage. People get a loan for a car. They don't save up 50,000 or 30,000 or 20,000 to buy a car. They go and get finance. So the whole model has been designed so that people are always chasing their tail on interest. How do you keep people on the hamster wheel? You charge them interest. That's how you do it. You do ex nihilo credit creation. You pretend the banks are lending their own money, taking a risk, and then you charge the slaves interest on their own energy, and fool them into believing that that's a righteous thing to pay the interest, because if you don't, you're a delinquent, and maybe you deserve to be foreclosed on, which is, the common belief of a lot of people, certainly a lot of people in the banking world. They're very passionate about people paying interest, because they think that's how the bank is. The only way the bank's going to stay in business is if people carry on paying the interest. But of course, they don't realise that the bank doesn't work like that at all. The bank could work perfectly well with no interest being paid to it. but it wouldn't be able to securitize then, you see, and that would be a problem for the banking.
No. Okay, so I understand that, and hopefully the audience will understand that, and that it's the energy doesn't have a value when it's first issued, but I get that over time, as that is then transferred into a debt, and the interest payments can be calculated on the debt and the term of the debt or whatever that may be, and how many times it can be sold on, they can attribute a value to that. And clearly, the only thing that's backing that is, like you said, the human energy, going out to work 40, 50 hours a week, doing all those things. So we are backing those securities, and they have I guess, a future value. And maybe for just, a layman here, I'm assuming that's where the phrase securities and futures may come from. Would I be right in thinking that?
Well, kind of, yeah. I mean, the futures is they are actual financial instruments that have a future value, and people are trading a spot value, which is the current value, speculating on, whether the current value is going to appreciate to a future value. That's pretty much what a future is. But it's kind of similar. If you think of it like this, right? So if you and I said today, tell you what, Andy, why don't we start a business? And we'll do a podcast every day, and we'll get loads of people to come and watch it, and we'll charge them to pay for our, listening and watching our podcast. And you say, oh, that sounds a good idea. I quite like the idea of that. Well, on day one of that venture, it's worth nothing, yeah?
Yeah.
Because we haven't got any customers. We've only got an idea, yeah? We've got no cash flow. You can't sell it to anybody. You might be able to sell the idea, but it's speculative. And that's what ex nihilo credit creation is like. You're putting your energy on the board through. It's actually the banks that arguably give it the future value, because they're going to charge interest. So it's that's perhaps the only justification that you could give them, is that because they're charging interest, because it's a slavery model, that debt that goes on the board at zero has a future value much higher or greater than, if you invert it, than the price at creation, which is zero. It's just like a business that has no value at the beginning, because there's no cash flow. It's all about cash flow. It's all about interest cash flow. There is no cash flow at the beginning. There can only be cash flow, interest payments, after the banks have converted it into a debt, and that's why it goes on at zero.
Gotcha. That makes more sense, and I think that'll make more sense for the audience as well. So let's talk a little bit about the actual Clifford Protocol then, because this form 1099 OID, again, I'm going back to not anything that you've just come up with or decided upon. We're now going back to stuff that's actually found in IRS publication 1212, in that the Clifford Protocol, how does it leverage this nominee reporting mandate found in publication 1212? Because you've stated that the banks are acting as nominees, and if you can leverage that mandate, you can file a corrective form 1099 OID, and you can report that withheld credit back to the true beneficial owner, or the taxes paid on that back to the true beneficial owner. How does that side of things fit in with this?
Well, the banks are supposed to file a 1099 OID for using the credit, using the human energy, but they don't.
How
so
convenient.
Yeah, of course, if they did, then they'd actually be telling the Treasury to redirect the taxes that they're paying to the originator of the energy. But of course, they don't do that. So when a foreign grantor trust files 1099 OID, it's doing what the bank should have already done. It's telling the Treasury who the tax belongs to, because it's about the tax redirection, right? So the banks are paying taxes when they should be they should be filling in 1099 OID, giving it to the Treasury, United States Treasury, and naming the recipient. But they don't do that. They just pay the taxes on their 945 modules, which is one of the reasons why they underfund, because nobody knows, well, apart from the United States Treasury, nobody knows who the recipient should be. So that's one of the reasons why they underfund, because very few people ever show up and say, well, those taxes that you're paying on your 945 module belong to me, because it's almost impossible to claim them as a living man, woman, unless you've got the Grantor Trust set up, which a lot of people haven't made that linkage. They don't get it. They haven't realized how you qualify to get the tax redirected is the 98 Grant Series International Grantor Trust, which you and I have spoken about many times. When I realized that, it was, to me, it was like, you just found the missing part of the equation. It's like, wow, I found it. Now I can make it work. It's like you're trying to build some engineering project, and there's one component that you can't find it. So therefore the whole machine doesn't work. And that one component in this machine was the International Grantor Trust that makes the whole machine work. Without it, it just simply doesn't work. It's like if you had an engine with no spark plugs, it just wouldn't work.
Yeah. I know you've often referred to this in the holder in due course. That is everything. So let's talk a little bit about that as well. So the foreign grantor trust itself. I mean, if I attempted to file a 1099 OID and I did that claim under Social Security number, SSN number, or an ITIN number, the IRS's automated system, it's got an information returns document matching system, hasn't it, that you talk about? That triggers something called a process status 77 frivolous filing routine. And then it goes into an unallowable refund, a hold via something called transaction code 810. So this 810 freeze that we've referred to it in the past. So if I do it that way, as a debtor under an SSN number or an ITIN number, that is absolutely what would end up happening, unless it just slipped through the net for some apparent reason. So how does using a 98 series grantor trust and has to be assigned in a certain way? These are assigned by the IRS themselves, aren't they? By the Cincinnati International Unit. How does that stop the 810 freeze, the frivolous filing situation from happening? What is it about this structure that is so important to this process?
Well, it's a foreign to the United States grantor trust. It's an international trust, which means it's not part of the debtor tax system. It's like a nation. It stands on its own. It doesn't pay taxes because it's not a citizen of the United States. You see, the government, all of the companies, all of the corporations are all citizens because they're all corporate registered entities of the United States as taxpayers. But the Foreign Grantors Trust is not. It's an independent nation in its own right. And it therefore can operate as a nominee, as a creditor, because it's not a citizen of the United States. It's a foreign alien, basically. It's foreign to the United States, and therefore it's not a taxpayer. But there is a but, and my strategy is deeper than many people may have realized. Because if you set up a foreign grantors trust, where the grantor is a non-US resident taxpayer. So the grantor being the birth certificate construct. The birth certificate construct has to be non-US resident in order to establish the foreign grantor's trust. But then the key is then who is the trustee? Because there is a US test on control. And if the control of the foreign grantor's trust is from a US citizen, because citizenship isn't about living men and women, it's about corporations.
Yeah.
Then the foreign grantor's trust is no longer a foreign grantor's trust. It is then a taxpayer within the United States system. So the agency comes in here, right? So you've got MLITR research, which is an attorney in fact, can engage in attorney in fact under agency as a trustee. But because it's operating as an attorney in fact under agency, not as a trustee registered in the United States as a citizen, the foreign grantor's trust can operate with a master account, and which is MLITR research at the top as a corporation, but all of the grantor trust as sub accounts, appointing MLITR research as an attorney in fact under agency. And that distances the grantor trust control from United States based control to foreign control because of the attorney in fact, which also ticks the banking box as well. It's more complicated than it looks.
Yeah, for sure. Yeah. So once this vehicle's in place, and we know that that's the structure that you need to have, you talk about embedding that within this private trust company, this Wyoming status trust company. So how does the transfer of the original negotiable instrument give absolute enforcement rights to that trust as holder in due course? Because it's the holder in due course that's the important part of this, isn't it? And could you also explain, I think it's important at this point, to really kind of dig into when that kind of formal perfection of this status of holder in due course is actually synchronized into the database, into the federal database, because that happens at a certain point, doesn't it?
Well, the bank should be filing 1099 OID and naming the recipient as the holder in due course, but of course they don't. No, they just leave it. They just don't file it, and therefore they can use the credit energy, pay tax on it, and never have to disclose that they are not actually the holder in due course. It's just like they go silent and don't do anything, and therefore they get away with it. But until the foreign grantor trust files the 1099 OID. And under IRS publication 1212, whoever files the 1099 OID becomes the holder in due course. So when the foreign grantor trust files the 1099 OID and it's accepted into the IRS electronic system, now the grantor trust, in a perfectly in line with the IRS publication 1212, becomes the holder in due course, which is effectively the nominee for the creditor, because the creditor is the living man, woman who's not ever going to step on the monopoly board. But the foreign grantor's trust qualifies as a foreign grantor trust because it isn't being controlled by a United States citizen, and the grantor is non-United States citizen or resident. So it ticks the non-resident box, it ticks the foreign alien box, and it's now filed 1099 OID so that it's become the holder in due course, which gives it the credentials for the tax redirection, which the bank should have been doing anyway, but they never filed 1099 OID. Why would they want to do that? They want to use the credit energy and hypothecate it for profit. The last thing they're going to do is to disclose that they're not actually the creditors or the holder in due course. They're just going to presume that they are, because they will, and all their data will back this up. Hardly anybody ever files 1099 OID from a foreign grantors trust, so they get away with it 99.9% of the time, using the energy, not actually being the holder in due course, but presuming to be the holder in due course. And because they separate, and this is where the mortgage deception really is very clever, the local land charge is from the originating bank that looks like they provided a mortgage. They sell the note or the security to an investment bank who is presuming to be the creditor because they paid for it, never disclosing that they're not the creditor because they never filed the 1099 OID. But the giveaway is that they paid taxes on the 945 tax ledger. That's the giveaway.
Now, if you were the creditor, why would you be paying taxes? Okay.
When you want to call them out, if a bank says no, we're the creditors, and you say, well, why are you paying taxes on your 945 tax ledger then, tax module? That's the clincher.
Okay, let's move on. Let's talk a little bit about the case precedent surrounding some of this as well, because there's I want people to understand this is not just something that you've come up with and called it the Clifford Protocol. This is deep research over a number of years, and it's backed up by documentation, by IRS publications, and by case history as well. So because critics will often claim that these trust structures don't exist, it's just a theory. So let's look at some federal court evidence of that. Specifically, there's a couple that I wanted to talk about. There's one in the United States District Court, Southern District of New York, so the SDNY, and there's a litigation there, which was the SEC versus Samuel Wiley. How did that provide precedent for a 98 series grantor trust, and that they're recognized as taxable fiduciaries, separate from individual consumers or debtor constructs?
Well, in the Wiley case, the SEC were trying to say that Wiley, the citizen, was really he was the defendant, but he's saying no. This whole structure that he was running is through a 98 series, or I'm not sure if it was a 98 series, because you can have a foreign grantors trust with a different prefix, but let's just call it a 98 series foreign grantors trust. His argument at the Southern District of New York, which is where all the financial cases are heard, because all the investment banks are in New York, so the court obviously has a lot of financial cases, and his argument was pretty simple. It's like the SEC had no case over him as a citizen, or as the agent for a citizen, because all of his dealings were through a foreign grantors trust, which was separate from him. And that's the critical part. The foreign grantors trust was separate from the citizen. So if you look at what we're doing, the citizen, the straw man, the birth certificate construct, creates the deposit through the status of a banker by putting that deposit on the monopoly board, can't recoup it, can't claim tax redirection because it's a debtor, has to put a foreign grantor's trust onto the monopoly board, onto the trust, as a nominee for the true creditor, which is the living man woman, separate from, ring fence, separate from the citizen as the taxpayer. And in the Wiley case, Wiley won on the basis that the foreign grantor's trust is a separate entity from the taxpayer, which is the citizen, the straw man, the birth certificate construct, which means that when you're looking for a separation, and that's what I was looking for in 2024, I've been looking for how can a 1099 OID filing be how can it be executed separate from the taxpayer? Had to find a vehicle. Is it a corporation? No, corporation's a taxpayer. Is it a domestic US trust? No, US domestic trust is a taxpayer. So I was looking for an entity that could sit on the monopoly board to file 1099 OID, separate from the taxpayer, which is the birth certificate construct or the straw man. And I came across the Grantor, foreign grantor's trust.
Gotcha.
And that was it. And recently I've been looking at, I know this, I've read about it. It totally makes sense to me. But is there any proof? Has somebody gone in a courtroom and put that argument forward and won? Well, yeah, here it is, the Wiley case, which is very important for lots of reasons, because if the foreign grantor's trust is filing as the holder and becomes the holder in due course, if it is viewed as and perceived to be the taxpayer, it's not going to work. No, so it has to be separate from the taxpayer. There has to be that Chinese wall or separation from the taxpayer, and the grantor, foreign grantor trust is that piece that you can use. And it's quite interesting when you study it as the origins of it. Why would they bother having it? Some people might be thinking, well, why, if they want everyone to be a slave, why would they leave the international grantor trust?
The door open.
And the reason for that is because some of the elites use it, and they don't want to get rid of it because they presume and assume that the overwhelming majority of people will never figure out how to use it, so we'll just keep quiet and let the elites use it, and not worry about the majority, because the majority will never figure it out anyway.
What about other case precedent as well, or certainly other cases? I know that we've spoken a lot about foreclosure, for example, on mortgages, and so for entities like the big banks, like the Deutsche Banks of this world, when a foreign grantor trust serves them with a formal notice of adverse claim, how does that trigger what you reference in the report as a prudent person standard of care under the Trust Indenture Act? How does that constitute any subsequent failure to halt a foreclosure as being neglect on their part, for example? Because it goes way beyond just the normal day-to-day commercial system of going out, taking out a mortgage, and going to work and creating credit that way. If somebody is in that horrible situation of maybe foreclosure and about to lose their house, if they knew that they were the creator of the instrument in the first place, how does the foreign grantor trust fit into that situation as well?
Well, the investment banks, they run this service called indentured trustee, or an indentured trustee service, which is basically the investment banks holding all these securities in bundles in investment pools, and their standard defense is that if your mortgage note is being held by them as an indentured trustee, their obligation is to the investors in the bond. So they're running an investment service. Their customers are investors. Their customers aren't the mortgagors, the alleged borrowers. So they normally, if you try and sue the indentured trustee for neglect or for non-reporting or anything like this, their standard defenses, and they win nearly every time I've looked at, that they don't have an obligation to the mortgage or the alleged borrower. They only have an obligation to the investors. So they don't have to provide any services to the borrowers, the alleged borrower within the mortgage, because that guy is not their customer. That's what they say, right? Their customer is the other banks and pension funds and big investment houses that buy bonds from them, and their obligation is to the investors, not the borrowers within the mortgages.
Okay.
And they win on that basis. But their problem is that if they are holding a security, a mortgage note, and the mortgage note, they presume that they are the creditor, and an adverse claim has been served against them, which says that that presumption that they're making is being challenged. Are they really the creditor on this particular mortgage note? And then when the foreign grantor trust files 1099 OID, and the foreign grantor trust, at the moment it files and it has its filing accepted, becomes the holder in due course, now the investment bank indentured trustee is no longer got an obligation of that particular mortgage note to their investors, because it's now come out of their portfolio.
Yeah,
it's only in their portfolio because they presume that they are the creditors and they have a creditor status over that particular mortgage note. But now it has to come out, because the holder in due course that they presume is them is now being proven to be the foreign grantor's trust.
right.
So now they've got a problem, because now they can't hide behind this. They're basically saying, well, we don't have to worry about the mortgagor anymore, because they now do, because now they've got a fraud going on, because now they've taken in a mortgage note into their investment structure, presuming that they are entitled to hold it and provide investment returns to the bondholders. That's the investors in their pool, in their indentured trustee investment program. But now this particular mortgage, the one in question, shouldn't be in their pool, in their portfolio.
No.
And if they keep it in there, they are committing fraud, aren't they? Because it doesn't belong to them. And the debt is being discharged. They've got two problems. They've got problem number one is they're no longer the creditor, the holder in due course, because the foreign grantor trust is. And the second problem they've got is that there is no debt. And their whole portfolio is about debt. But the debt's been discharged through the filing of the 1099 OID. So they've got a big problem. And they can't claim that they didn't know about it, because that's what the adverse claim is about. So you're basically putting them on notice for the adverse claim. And it's not the mortgagor that does that. It's the foreign grantor's trust that serves a adverse claim against the indentured trustee that says, it looks to us like this particular mortgage note you're not the holder in due course. We are. We, as in the foreign grantor trust, are. And that's what the prudent person, and all a prudent person is somebody of sound mind would look at it and say, well, does that look right to you? A prudent person would, unless they're insane, would say, how can this indentured trustee claim that they have that mortgage note in their portfolio when it's been discharged, which is the crux of it. It's been discharged, and B, they are absolutely not the holder in due course anymore. They weren't in the first place, but they presumed to be. Now it's been proven that they're not. So that on both substantive points, a prudent person would say, nah, you know, the indentured trustee should hold their hands up and walk away from that mortgage note because it's been discharged and it's not theirs.
Gotcha.
And it was theirs, actually.
And how is that, just before we kind of end this section, how is that further corroborating with the foreign grantor trust structure? I mean, could you speak, for example, to the Shane House presentment and how that also adds further weight to this structure that you're using here?
Well, Shane House is the, you know, you've got two main case precedents, and Shane House is the second one, where again, big Southern District of New York case. Shane House argued that what we've just said, really, that the mortgage note didn't belong to the indentured trustee. It won the argument. It's those two cases are pivotal to, if you are looking to discharge a mortgage using a foreign grantor trust 1099 OID filing, the grantor trust becomes the holder in due course. You've got to be using these two case precedents, which have already been decided in the Southern District of New York in that jurisdiction, which is where you'd be taking on the mortgage indentured trustee in the same court venue. You've got two case precedents that's going to make it pretty difficult for an indentured trustee to use their standard arguments, because they've already lost on those two already. So it's difficult for them. Given the legal system is based on case precedent, they have a job coming up with. And I looked. Are there cases where foreign grantor trusts had lost on those? You know, are there any cases where it swings back in favour of the banks? And there aren't any.
Okay. So very powerful. Very powerful.
Yeah, I mean, in some areas of the legal system, you see thousands and thousands of cases which are all kind of the same. Many people trying the same arguments and losing. But in the realm of the foreign grantors trust, it doesn't come up very often because not that many people know about it or even use it. You see, so it's not too much of a problem for them at the moment because very few people know what it is. What is a foreign grantors trust, and how do you use it, and why can it defeat the banks? Together with 1099 OID, set up in the right way, etc., etc. Very, very few people know about this, so I don't think that the banks are particularly worried at the moment. And they might become worried when they lose a few times, because this is their Achilles heel, right here. You're never going to win on all the other things that people are trying to, say in courtrooms, and you're never going to win in the local courtroom using this presentment, because the local courtroom is just going to say it's nothing to do with them. It's not going on in this country. It's nothing to do. They don't want to get into insecurities and theories of this type. They'll just knock it out. But not in the Southern District of New York, where the defendant is the investment bank in their own backyard. It's like, you're right in their backyard there in the Southern District of New York.
Goodness me. Yeah. So let's move on to the next section then, Ian. In terms of the the adversarial side of things as well, because I understand how the OID side of things works now. You've got your 98 Grantor Trust. We're the people that are obviously issuing the credit, and you can file for the taxes to be redirected back to the original source, which is the creditor, and that there's that separation between the Grantor Trust and the living creditor themselves. But there's also limitations to how much you can actually claim back here, isn't there? So I wanted to just touch on that as well. As far as the actual high value claims versus what can go through more smoothly, and any kind of challenges that you may face, even using the Clifford Protocol itself. If it's not done in the right way, that could present bottlenecks. It could present challenges as well that we don't really want to have to manually overcome. So there's a limit, isn't there, that you've established of $2 million, and that if a refund exceeds that, then it goes into a mandatory manual review. And it's not the IRS that are reviewing that. It's another body called the JCT, the Joint Committee on Taxation, that they're the ones that manually review that. So what is it about the Clifford Protocol? Why do you dictate a strict operational parameter here of keeping individual recoupment claims at or below 2,000 or 2 million, per grantor trust per year? What would happen if it was over that amount? What's this manual review process look like?
Well, it's in my treatise that I've written about this because, again, the IRS have a algorithmic system. So you fire in a $10 million 1099 OID, even though there might be enough taxes that have been funded on the 945 module, you go sail all through the system. And then when the trust files 1041, it's if it's over $2 million, the 810 algorithm is going to cut in, and it's going to look at the value of the tax redirection being 10 million in this example, which is more than the 2 million, which is going to trigger a manual review. They don't get that many very high value tax redirections. So they're going to put it into manual review, and the grantor trust is then going to have to justify that it is the holder in due course, that the taxes that have already been paid on the securities, underlying securities that are being filed against, the taxes do belong to the foreign grantor's trust, which it can evidence because it's got the CUSIP number, it's got it's got all the credentials, it's got the agentic AI searches, and it can match all these different, join all these dots up. And it can absolutely qualify because of the foreign grantor trust status, not being a taxpayer, not being a retail taxpayer, which is what they would be looking for. But it is going to go into a review. And a review, it means correspondence. It means months of delay. It means rounds of technical exchanges between the grantor trust and the JCT, looking at, they have to sanction the IRS to release the tax redirection. So it's not the IRS that you're battling against. It's the JCT, which their job is to make sure that tax law is being followed. Yeah. And I think on balance, there's a very high probability of winning against the JCT. But it's not going to be, send an email and just put 2 paragraphs in your email and they go, oh yeah, fine, yeah, no problem. Off you go, crack on, and we'll tell the IRS to send 10 million to your trust as a tax redirection. Their job is to challenge it, and that's where I don't want to have too many manual reviews. I don't really want any, but it'd be like a court case. And the problem is that if it goes to the JCT and they say no, they don't agree, then you have to appeal it. And now you're going to go into a federal court. And the grantor trust is going to be in a federal court where the plaintiff, in this case, would be the grantor trust. And it will be like a tribunal type thing. You know, that you're going to have a claimant being the grantor trust, and you're going to have the JCT defending their interpretation of tax law. I seriously just don't want to go there, really. You know,
no.
It's got enough to do as it is, let alone fighting the JCT and being going to the Supreme Court. You never know where it could go to. And they're obviously going to want to safeguard the system. So
of course they are.
Going to put up barriers, aren't they? They're not going to go, oh yeah, fine. Yeah, we've read your treatise, Ian, and we agree with you. So we'll just tick that box and send it back to the IRS, and the 10 million will flow to the grantor trust through the Treatise 310. I don't think it's going to be as easy as that. I really don't.
So how does keeping the return below this threshold, how does that satisfy this perfect match? The logic of the 810 algorithm, bypassing this manual kind of bottleneck with the JCT as well, and then allowing the US Treasury to actually process the payment, because they'll process the payment. They don't do checks anymore, do they? They process the payment via ACH or via FedWire as what's called an IRS Treatise 310 transaction. If it's kept below the 2 million, how does that satisfy all of that infrastructure?
Well, you're ticking all the boxes. So you've got the foreign grantors trust, which is not the taxpayer. It's got its holder in due course status. It's quoting the right reference numbers, the CUSIP number for the securities. That's the investment bank's been paying. The street name. It's created this name through the DTCC, the Depository Trust Company. You can say the taxes that the investment bank is paid is on against this CUSIP reference security, and there's enough taxes on the 945 tax module. There's equal to or greater taxes on the tax module than the amount of the grantor trust is trying to redirect, because obviously you can't redirect taxes unless they've been paid. So that you have to make sure that there's enough tax on the module, 945 module, for all of the grantor trusts that are filing against that investment bank's tax module. And if all those boxes are ticked and it hasn't flagged a manual review, then it should go through electronically without any interference. But as soon as of course, they've hardwired $2 million, you could tick all the other boxes apart from $2 million, and it's going to go straight into a review. And given that we're doing thousands of filings, the last thing we want is thousands of manual reviews.
Absolutely. Okay, let's dig a little bit deeper into this as well. Let's talk a little bit further down the line in this process, because you make reference in your treatise about the 945 tax module. We've spoken about it a little bit earlier on as well. So let's dig into that side of things, because to understand how the IRS kind of record their data, can you break down this architecture, this master file transaction code architecture? What's the scope? What's the functionality of the Form 945 module compared to maybe other tax modules? You know, there's plenty of others. We talk about the 1120 as well. There's lots of other, there's income tax ledgers, there's corporate ledgers, and then there's this 945 that is very, very, we're very interested in that one in particular, aren't we? So could you just break down what exactly that is? How does it work?
Well, the 945 it's got taxes on certain classes of activity, things like annuities and pensions and stuff like this. So there are very defined category. There's a category And within that category, you've got certain taxable events going on where the banks are funding the 945 tax module for things that it does that generate taxes for a list. And I can't remember the full list without looking at my notes again. But one of the things is ex nihilo credit creation.
Oh, wow.
That's
Oh, wow.
Yeah.
That is
They don't
actually
actually say
listed on there.
They don't say it in those words, but they refer to 1099 OID. So you've only got to join the dots up.
Yeah.
It's the tax module for the signature credit.
Okay.
And that's why the banks don't fund it. They underfund it because they don't need to fund it at the correct level, because hardly anybody is redirecting the taxes from it. And it doesn't matter to the Treasury whether they receive taxes for the 945 module or the 1120 or any other module. They're getting the taxes, which they don't need, by the way, but they're getting them anyway. So they're not going to go back to the IRS isn't going to go back to the investment bank saying, "Oh, we notice you're a bit light on your 945 module. Top it up a bit, will you?" Because nobody's drawing it down from the 945. No. Hardly anybody's drawing it down from the 945 module, so it doesn't matter. Which is why the banks don't bother to fund it. And I think the other reason why is because if they started putting hundreds of millions on the 945 module, and someone like me comes along and starts doing some research, it's like, oh, that's interesting. So you are blatantly admitting that you are paying taxes on OID, original issue discount, for ex nihilo credit creation. Because I can see how much tax you've paid on your 945 module, and that module is predominantly for 1099 OID tax on ex nihilo credit creation. So that's another reason why they don't fund at a high level, because they don't want to draw attention to it. But there is a but.
There is a but. Okay, there is a but. Okay.
Well, the but is that if you couldn't compel them to transfer, this is the IRS, taxes from other tax modules to the 945, then there'd be a big problem here, because the grantor trust may be the holder in due course, but if the bank that is the payer hasn't paid enough taxes on the 945 module, and if there was no mechanism to command the IRS to move taxes from other tax modules to the 945 tax module, then the grantor trust would never be able to redirect the taxes, because there wouldn't be taxes to redirect. So that, to me, that's another pivotal. It's like the case precedents. You put all these things together, and it's like that confirms it, that confirms it, that confirms it, that confirms it. That this has got substance.
So let's dig into that a little bit then, because while they're underfunding the 945, because nobody's claiming 1099 OID particularly, we are, and we will be moving forward. So if we were in that situation where the amount of 98 grantor trusts that had been created and the 1099 OID amounts, even if they were all kept under that 2 million threshold, if that combined amount exceeded what was on the 945 as taxes paid, you also refer to revenue procedure 2002 to 2026, don't you? 2002 to 2026. How does issuing that manual command to direct the IRS to reallocate from one tax module to another, particularly we talked about the 1120, there's billions on there, for example, and there is the ability to not ask them to, but to command them to move from one module to the 945 that is underfunded to make up the necessary shortfall. Can you explain how that works?
Well, to me, when I saw that in the legislation, it's like, wow, it's another big tick in the box here, because if the grantor trust can establish itself as the holder in due course, it has an entitlement to tax redirection, and because it's a nominee for the creditor, and the taxes belong to the creditor. The creditor being the living man, woman who's not on the monopoly board, not in the trust or not sitting on the trust. So when I saw that the holder in due course, being the foreign grantors trust, could command the IRS to move taxes onto the 945 module, that told me that the 945 tax module has to be the dominant tax module. There's no, you can't command the IRS to move taxes away from the 945 module to an 1120 module. It's only from the other modules to the 945. So that tells me that the 945 tax module is the dominant tax module. And if the holder in due course grantor trust can step into the shoes of the taxpayer and command the IRS to move taxes onto the 945 module of that taxpayer, being the investment bank, it tells me it's favouring the holder in due course. It tells me that the holder in due course is the head honcho in this scenario. It's like, if you as the holder in due course trust can command the IRS to move taxes from Goldman Sachs, Morgan Stanley's tax modules, it tells me that the holder in due course is a very powerful position to take up, and to be able to command the IRS, not just because you want to do it, because you're referring to Revenue Procedure 2002-2026. It's been put in the statute book that the holder in due course foreign grantors trust can do this. Why would they bother doing that? Why would they write that into legislation if the holder in due course wasn't as powerful as it clearly is when you research this?
Just more verification yet again that everything that you've outlined in this treatise and in the Clifford Protocol has documentation, has case precedent, has internal structure within the IRS to back it up as well, which is incredible. So let's move into the next section as well, because I know that you've written papers on this too. And again, you're including basically all the papers, everything that you've written, the reports you've written, every single individual component of those are in this treatise. And I love the fact that you've put that together. One of which you call the smoking gun. So I want to talk about this as well, this forensic ledger tracking, this 26-digit reference point within the IRS. So let's talk about that, because when it comes to tracking, if every single security is tracked and traced, and we're talking about not just mortgages and large balance loans and things like that, every time you tap your phone, every time you go to the supermarket and you buy something, that is a new security that's been created, new credit on the monopoly board. And you're saying that every one of those has this 26-digit IRMF reference string as a fingerprint for it. So let's just demystify that for people, for tracking and accounting of these types of things. How does this information returns master file, how does it expand, or even why does it expand just the standard 14-digit number into a very specific 26-digit alphanumeric string? Why does it do that?
Well, if you break it out, and in my report, I break it out into sections of what the numbers mean. You know, it's like a postcode or a zip code. You know, you can determine what you're looking at by the sequence of letters and numbers, and you break it all out. And it basically, it's a way of identifying. It's a bit like if you've ever watched the Enigma the movie about the Enigma machine.
Oh yes.
All these
Oh yes.
The Imitation Game is the name of the movie. It's like a whole series of references or numbers or letters in a jumbled up fashion. But if you know the code, if you know what the sequence means, and you add those sequences together, then you can identify the origin of the signature credit, which is what they're trying to do. Where was it created? What type of security was it? What's the value of it? Where is it now? it's all in that 26-digit reference number, which enables them to track everything. Think of how many transactions there are, not just now, not just today, but go back for when digital transactions first came about. I mean, before the digital transactions, they were doing all this on paper. Can you imagine that? I mean, they must have had warehouses full of paper to try and record all this stuff.
Yeah. So why do you reference this code, this extraction, or the extraction of this 26-digit code, as the absolute smoking gun of the protocol, of the Clifford Protocol? What's so important about it?
Well, because it ties together if you think of it like this, if there wasn't any way of knowing that when you sign for a mortgage, loan, credit card, or even a bank payment, if that just got lost and there's no tracking of anything, right? It's just like, just sign a form, and then they throw it away. There's no recording of it. Or you go on your phone, you type your 4 digits in on your debit card, and there's no record of anything. If there was no record, then they wouldn't know the value of the master file. So everyone's got a master file value, yeah. So when you turn up and you want to redirect taxes, they're going to look at the master file. So if you come along and say, I want $2 million of tax redirection, but you've only put in 100,000 of transactions, you can't have it, yeah, because they need to track. So the tracking of the signature credit, the origin of it, and all other aspects of it which identify it as to who originated it, where did they originate it with, which bank did they originate it with, which securities did it go into, what's its value. If they didn't want to track that, if they didn't care about that, they wouldn't know what the slaves were doing, yeah.
Right.
So it's about knowing what the slaves are doing and how much economic activity each slave is put on the monopoly board. They're tracking it because just in case, and I don't think they probably imagined that the Clifford Protocol would come to the market, but they are tracking it because if they weren't tracking it, it's probably a better way of saying it, if they weren't tracking it, it wouldn't be the system that we've been talking about. They are tracking it because by tracking it, it confirms that it is a modern slavery system. That's how I see it. If it was what a lot of people believe it to be, a system where you transfer money from this account to that account, that's a deposit, and all they've got to do is record where it is now and not where it came from and how it was originated, why would they bother having a 26-digit reference?
Yeah.
It verifies the ex nihilo credit. It verifies the fact that there is signature credit energy being used. It verifies the banks have got to pay taxes for the use of the signature credit. If there was no referencing, no way of anybody knowing what, who's using what, who's paying tax on what, how would the banks know what tax to pay? They wouldn't know if there wasn't any way of tracking anything.
No.
So to me, the tracking of it is the smoking gun, because if there was no tracking at all, it would just be complete randomness. But the fact that they are tracking it, to me, confirms that there's signature credit being created all the time. And the bank,
Amazing.
and the banks have to calculate the taxes based upon the referencing of RMF code. So that confirms to me, along with the case precedents and everything else that we've spoken about, that my treatise is right on the money. That's what it tells me.
Yeah. Okay. Let's move on to the next section then, Ian. So I want to talk about risk management here as well. So pre-verification of the 1099 OID postings. Let's talk about mitigation. Let's talk about timings. You know, the parts of the protocol state that it's possible, entirely possible, to electronically file the corrective form 1099 OID before any 945 verification has been established, with absolutely zero risk of triggering any kind of automated freeze. So if you could walk me through that, because again, this is a shift in what we thought versus where we are now, which makes a big difference in terms of throughput. So how's this sequence of the IRS processing this pipeline? How does it create a safe environment during the initial posting phase where we're not subject to an 810 freeze, even though we don't even have verification that the 945 has enough on there to accommodate the filings?
Yeah, it's not as simple as it appears. So what they're doing is they are, if you form a grantor trust, file 1099 OID, and you basically have got everything wrong. Yeah, you've got the payer, the wrong payer, the wrong recipient. You've got the wrong EIN number for the payer. You've got a nonsense CUSIP number. They're not going to issue a wages and tax transcript. They're just not.
No.
So it's like a two-stage thing, right? So the first stage is it a foreign grantor's trust? Has it got the credentials to file 1099 OID? Okay, yeah, fine. Is there a taxpayer? Yeah, there is. Yeah. Is there a recipient? Yeah, the recipient is the foreign grantor's trust. Is the CUSIP number of the payer? Is that, it's the securities that they're paying the taxes on? Is that real? Is there a real CUSIP number that that matches that? Yeah, okay. So this is like the early verification that the filing is ticking all the boxes so far. But the crucial box, there's two crucial boxes that they're leaving to one side, is the 945 tax module. Is there enough on there to cover all the 1099 OID filings that have come in against that taxpayer? And how many of those are these filings over $2 million? Which they wait until you've done the 1041.
Yeah.
So they're gonna give you a green light, but they're gonna wait for the last two verification checks, which is the 945 module. How much tax is on there? Is there enough to redirect? And is the amount being redirected more than 2 million? So that's where the 810 freeze is going to come in.
Yeah.
There's no point freezing it before, but they wouldn't issue a wages and tax transcript. So it's like a verification process that ticks the boxes like an A through Z journey. If all the boxes are ticked up to a certain point, the wages and tax transcript's going to come out. And then, but they're not, that doesn't mean that you have completed the verification yet, because the two crucial parts are yet to come, which come in after the 1041's been filed. So what we had in 2025 was all the boxes being ticked up to the verification of the 945 modules, which is logical because we now know how much tax is being paid on all the 945 modules, and we would have had to have moved taxes on certain of the taxpayer modules to facilitate the wages and tax transcript values that came in last year. Not for all the banks, but for some of them.
But for some. Okay. Okay. So when the IRS receives that and they accept that corrective OID form through their system, and the data enters into their master file and links to the trust's EIN, why is the IRS able to then successfully issue a wages and tax transcript with that 26-digit fingerprint on there without any risk of a freeze occurring? Is it just that there is a separation between verification at the front end versus verification at the back end?
Well, they're verifying it up to a certain point. They're just not verifying whether there's enough tax to redirect. They only do that when the 1041 is the tax return. So just because you filed 1099 OID, they don't actually know that the trust is going to file 1041.
Okay.
The trust might be filing 1099 OID just to become the holder in due course and to discharge a mortgage, for example. They don't actually, know that there's going to be a 1041 filing as well, which then means redirection of the taxes from the payer's tax module 945 to the grantor trust. Just because the 1099 OID is being filed, it doesn't necessarily. Everyone in our program thinks that filing 1099 OID automatically means recoupment, but it doesn't.
Right.
It's a corrective filing. It's to correct who the holder in due course is. Yeah. So that you see, the wages and tax transcript is telling you that the grantor trust they've affirmed that the grantor trust is the holder in due course, and the amount of taxes that are on the wages and tax transcript are available to be recouped, but only if a tax return comes in, which is the 1041. But if you were just doing it to create the holder in due course position for the grantor trust, I mean, I don't know why anybody wouldn't want to file 1041 as well. But if you were just doing it to get holder in due course status because you wanted to redeem your mortgage, discharge your mortgage, and you didn't want to recoup the taxes as well, that's why they've broken it up into two stages.
That makes sense.
Verification up to a point, and then it's verification before they release the Treatise 310, which is the ultimate transfer of the funds to the grantor trust.
Okay. So I'm assuming what this would allow us to do as an organization and as a filing team is to file 1099s before we have confirmation of what's on the 945. Up to a point, we would no doubt be able to even file 1041s because there's going to be a bucket of so much taxes withheld on that 945 module that can be recouped.
Yeah, so if you take all of the members and say, well, we've got 1099 OID, which is happening, so that you've got you've got the wages and tax transcripts they're in progress, and then once you've got those, then you look at the what's the 945 tax module looking like. We're filing 1041. We can't exceed the value of the 1041s, can't exceed the value of the taxpayer's 945 module. So it's at that point where the cross-modular transfers would have to kick in after the wages and tax transcripts come in, and before 1041s have been filed. Not all of them, because you're better file up to the limit of the 945 tax module, and when that's been exhausted, then do the cross-modular transfer.
Gotcha. Okay. So next thing I wanted to cover, Ian, is also to do with this Genius Act and the Clarity Act. Let's address some of these modern sort of regulations that have come in. So there's the Federal Tax Administration is sort of shifting heavily towards automated compliance. We're seeing that with banking, with what we've been doing here as far as the actual filings as well. And there's this compliance under the Genius Act of 2025. I love the name Genius Act. We all know what I'm sure there's a different meaning to that in reality. And then the Clarity Act as well of 2026. Talk to me about why the Clifford Protocol is completely unaffected by things like stable coins, these type of jurisdictional boundaries, or even this new sort of digital broker reporting rules under Form 1099 DA. Why are we unaffected by that?
Well, I put this in the treatise because we've been talking to banks, and one of our internal members was, who's part of the process, was saying, is this, these acts that have only recently come about, are they going to stop us in our tracks even? Because are they moving into a new system that doesn't use ex nihilo credit creation and human energy to back it all? Because there's these new acts that have just come out in 2025. So I'd already looked at it some months ago and just decided that nobody's talking about it, so I'm not going to put it in all my research papers. But then someone did start talking about it. So I'm thinking, well, if one person's talking about it, then I better put it in the papers. It's no good me knowing about it. I'll publish a section on it. I already knew it wasn't going to be a problem because the whole system is based on ex nihilo credit creation. You can't throw that system away without replacing it with a new one. Well, what are they going to replace it with that works as well as this system? I don't know of anything that they could replace it with that works as well as this one. So what they're going to do is, and that's what these two acts are really all about, is they're going to enhance it. They're going to enhance the slavery system by being able to track and trace it even closer than they already do. And that's why they're bringing these in, because they and they were quite clever actually. They talked about CBDCs for a long time. And a lot of people got hot under the collar about CBDC. We don't want them. Nobody wants them. We're going to object. We're not going to take part. Blah blah blah. We create our own systems. We'll abstain from using CBDC. We'll use cryptocurrency. We'll use other forms of bartering and things like this. So what they've done is they've sort of climbed back from using CBDCs, and they've put the Genius Act and the Clarity Act in there, which is stable coins. Well, stable coins are tracked and traced just like CBDCs.
It's the same damn thing.
It's the same thing. It's just called a different name. And they've wrapped it up in two acts that look very, who's going to read them? Not very few people. And no one's talking about CBDCs anymore, because it looks like they've sort of climbed back from that. Oh yeah, we were going to do that, but there was too much pushback, so we're not doing it anymore. Well, they're doing this, which is the same thing, just called a different name, really.
So how do these modern mandates then? How do they? Because when I think about the structure of what you've got here, and I want to move into the Trias 310 banking. That's kind of the last section that I want to cover. We've gone through everything to do with the IRS, history, where it all started, how it all fits in with the IRS, 98 Grantor trust structure, how we can bypass the algorithms and get these filings through, 945 cross-modular transfer. We've spoken about all of that. But there's one particular section here at the end of all of this, which is to do with the trust structure, but also to do with the banking infrastructure as well, that I just want to finish on. So the Wyoming private trust company structure, how do these new acts, these new legislations, how do they actually validate and mirror the firewalls and the protocols that we use?
Well, you see, CBDC was direct. It basically go direct. So consumer, user of banks don't have to use banks anymore to do transactions. That's what CBDC was about. Central bank digital money. Go direct. You're a consumer of products, financial products. why do you need to work through the banks? And that was what CBDC was. You could go direct to the central bank. You'd have an account at the central bank. Yeah. Why do you need all these other banks? That was the original plan for CBDC. And what they're doing now with the Genius and the Clarity Act is that they're kind of doing a halfway house through stable coins. So you've got like new types of banking entities that will come out, and the existing banks will modify how they do things so that they're using more stable coins than they are using Federal Reserve notes. But the stable coins are created ex nihilo in exactly the same way as the Federal Reserve notes, which are already digital anyway. So to me, it's like spot the lady on The Magician. You know, they're moving the lady around under the cup. It's like it's in there somewhere. We just make the cup look different, but the lady's still underneath. You know, it's like a magician's trick. But what it does give them is it gives them more control, which is what they want, of course.
Yeah.
That's what it's all about. In a nutshell, the Genius Act and the Clarity Act is about how do they get more control without spooking the world population by declaring that that's really what the purpose of these two acts is, by dressing it up and disguising it as its sophistication, its next level technology. It's going to make things much faster, much easier. You know, you'll be able to do transactions much quicker. You'll be able to go direct. You won't have to go through verifications and all this kind of stuff. When actually all it's about is just ultimate control, which is what CBDC was trying to give them. And Catherine Austin Fitts, who runs the Solari report, she's been talking about the digital concentration camp for many years now. And this is, I think that some of her message was getting out, and I think that's why they pivoted and changed the name of these things. They're equally as egregious as the CBDC, and the banks, of course, still play a big role in it. They're not being cut out, are they? So they're looking after all their mates, for sure they are.
Well, that's a great segue into our banking, because let's finish on this. Standard retail banking, those kind of high street platforms are definitely not equipped for what we're doing here, not for the routing of these kind of deposits. So could you explain how you've been able to kind of bypass that friction, that retail bottleneck? We talk about using self-clearing bank APIs. We talk about virtual account management. We talk about virtual IBAN numbers as well. And then there's another section within your report that talks about for benefit of as well, FBO, master custody architectures. I'd love to kind of dig into that, because to normal people listening to this, they're just used to their Barclays account or their Santander account. And if we've got a member who's going through the process, they're going to know that they can't. Well, they should know that they absolutely cannot suddenly move $2 million from a banking structure outside of the UK into their Barclays account and not have issues with that. So could you explain the actual banking architecture that we're putting together here?
Yeah, there's a couple of things which are quite problematic. The first is the trustee entity, which is MLITR Research, as a Wyoming entity, which it's an LLC that can operate as attorney in fact, and it can operate unlimited numbers of attorney in facts under the law of agency. So it can operate as an individual trustee for each of the grantor trusts. So you have individual grantor trusts, you have one LLC, MLITR Research, but it can separate itself out into an unlimited number of grantor trusts.
Okay.
Which ticks the box. But when you create a grantor trust, you have to have a trustee for the grantor trust. But the grantor can't be a US citizen, and nor can the trustee. Well, the Wyoming LLC is because it's operating under attorney in fact. You see the agent and the principal. The principal is the grantor. So I don't know whether I've made this clear. I'll try and make it clear.
Yeah.
You can't operate a foreign grantors trust with a US trustee because the IRS will say that that trust is not a foreign grantors trust. It's a domestic trust.
Yeah.
Yeah. So you can use a attorney in fact model, even though the Wyoming company, MLITR Research, is obviously a US LLC, it is operating as the attorney in fact for the grantor.
Who is non-US.
That is non-US. Because you need a US LLC to be able to open the banking.
Mm-hmm.
Mm-hmm. So if you had a non-US trust company, for example, you wouldn't be able to open bank accounts that comply with the IRS's Treatise 310, ACH, and FedWire, because the banks have to be US approved, part of the Federal Reserve International Monetary Fund system, which limits you to US banks. So you've got a problem here, right? This is what a lot of people don't realize. In my financial engineering, I solve problems through the design. So you've got, if you want to, if the grantor trust is going to qualify as holder in due course, it has to be non-US.
Yeah.
But to bank the redirection of taxes, the grantor trust can't have a trustee that is US, because it would invalidate the holder in due course.
Yeah. But you need it. Right? You need a US bank account.
So you could get tax redirection, but you would never better bank it.
Yeah.
Yeah. So I've solved both problems with the Wyoming MLITR research structure, because it can operate as an attorney in fact under agency. It is acting for the principal. The principal is the grantor that is non-US.
Yeah.
But when it opens a bank account, when MLITR research opens a bank account, it can open a bank account as a US LLC, and it can open up a sub account for each of the grantor trusts. So it can operate a US bank facility whilst not contravening the foreign grantor trust status.
Yeah.
Yeah. Because it is not a trust, it's not a US trustee, it is an attorney in fact for the grantor that is non-US.
Yeah.
So I've achieved both objectives with one structure.
No, I think it's genius. No. And it does. That solves everything.
Yeah.
No.
Because the banking, I don't think people.
Yeah, I don't think people fully understand the complexities of what needs to be put together at the back end as well of this. So as far as potential other problems or other sort of milestones that we've had to overcome here, I know one of them that you spoke about was a 3 refund rule as well. Because if we just had an individual bank account set up under MLITR research, okay, it's a US bank, okay, great, we can receive, Treatise 310 recoupments coming in, but the US Treasury enforces a 3 refund rule. So you're only limited to 3 electronic deposits to a single account per year. So that would mean we could take in 3 members' recoupment and no more, if that was the case. So how does this virtual account model that you've got, how does that sort of map thousands of unique 98 series trusts with their own bank accounts? Obviously, they've got a distinct sort of endpoint to that particular account. But how does that bypass this 3 refund rule or this bottleneck that we discovered as well?
So if you get a whole series of grantor trusts, which is what we've got, and you want to have a single trustee for all of them, one trustee for all of them, the only way you're going to do that to avoid the 3 check per annum restriction from the IRS is to have a regulated trust company. But a regulated trust company would be a US regulated trust company.
Right.
Which would then invalidate the 98 series
the 98
grantor trust. It would become a domestic trust, right? So we had a guy who worked with us for a while who couldn't understand these things, right? And I'm saying we don't want a US trustee, one trustee for all of our grantor trusts, because it makes the grantor trust a US domestic trust. And that doesn't qualify as holder in due course.
No.
Because that would completely destroy the whole foundation of what we're doing, right? It's holder in due course, foreign grantor trust to get the tax redirection model to work. So if you then go and load in a trustee that's a US trustee, and then, you know, because you want to avoid the three check per annum problem, you're going to invalidate everything.
Yeah.
So the remedy to that is the master and sub account, which is attorney in fact, an LLC that can operate as one single entity, but it can operate as an attorney in fact for multiple grantor trusts. So when the IRS pay the ACH and Fedwire to an individual grantor trust, it's a separate account. It's an individual account with its own account reference number as part of a portfolio of accounts. So the individual grantor trust account is not going to be receiving more than 3. It's only going to be receiving 1 Fedwire or ACH per year. So you've got an attorney in fact model which enables the grantor trust to stay foreign whilst ticking the boxes for the IRS no more than 3 check rule, because you can segregate and individually open up individual accounts within a master account structure. So you can tick the banking box, you can tick the foreign grantor trust box, and you can tick the IRS no more than 3 checks in 1 year. And you can also tick the don't want a US trustee, because that would invalidate the trust, and plus it would be majorly expensive. I achieved all of those 3 things with the Wyoming structure. But that's financial engineering, right? You have to understand things. You have to know the nature of the problems. It's a bit, I was watching a movie last night. It's actually a series. It's called The Queen's Gambit. If you're into chess, it's really worth watching it, right? And, you know, chess masters, they can think on multiple levels, They can think many moves ahead. They can see what can happen on the chessboard. Well, that's what financial engineering's like. You've got to be able to see all the different scenarios and come up with a solution that is going to, it's like any engineering, really. You've got to be able to avoid problems and create the solution in a structure. And that's what this is at the back end of it. And because they're called BAAS structures, so they're like intermediaries. Let's just call them intermediaries. They're banking platforms that have direct access to the bank's systems. So the banks can open up accounts via the intermediary, the BAAS system or the platforms, segregated accounts for each of the grantor trusts with all centralized documentation as well, because you've got to think about that. How do you open these accounts up? You know, you can't just open accounts without anti-money laundering checks. You know, who's the grantor? Let's see the trust indenture. What's the source of the money? Da-di-da-di-da. You can't just go into a bank and open up 3,000 accounts.
No.
Without them knowing all about it, right? So they get to know MLITR research through the BAS platform that will enable it to do central due diligence on MLITR research, that is then got the ability to open up all the sub accounts, and MLITR research can load up the anti-money laundering, trust indentures, proof of this, proof of funds, etc., without going to the members and saying, can you provide this and this and this and this so that we can open a bank account? And by the way, you're going to have to go and open it. And then you've got another problem, because you cannot open a US bank account for a non-US resident.
No.
So we couldn't even go to the members and say, hey, here you go, open this account with Bank of America, or with Wells Fargo, or with Chase Bank, and then you can receive your Trias 310, Fedwire ACH, $2 million. Just go and fill these forms in, and you'll be okay, because they won't open a bank account for non-US resident. So that's another problem, right? And if you go outside the US, say, oh, that's not a problem, I'll go to Santander in London and open an account there. That's not part of the ACH or Fedwire rails. The IRS can't transfer anything to it. So you've got to stay in the US system. So the Wyoming structure solves many, many problems in one. That's why I formed it. That's why I got it off the ground. Can I get people to understand all the moving parts of it? Maybe.
I think you've explained it very well.
Explain it, yeah. It's not as easy as it looks, guys. It really isn't.
No. So just finally, Ian, I know there was one other section that we that you discussed in the report, which is this MSB trap as well. So how does using this hub structure neutralize the risk of that happening? This multi-party tax disbursements, there's regulatory hazards there in terms of receiving high volumes. Talk to me about how the architecture of the master accounts, sub accounts, and having all of that in place mitigates that risk.
Well, that's the money services brokerage. So you can't operate as a broker of money without a license.
Right. Okay.
So if you set up an LLC and then you start receiving funds, hundreds of payments are coming in, and then you're going to on behalf of someone else, right? You can't operate like a brokerage where you're receiving funds and you're going to pass them on to the ultimate beneficiary, for example, because that's called a money services business, and you have to have a license for that. You're operating like a banking platform. But not with the Wyoming LLC structure, because it's all to do with collectives, right? So if you're collecting money in one account for the benefit of many others, that needs a license. But if you've got individual sub accounts and you're collecting money in the sub account for someone else, which in this case is the Grantor Trust, that's not a money services business, because it's individual. You're not collecting the money in one pot and then distributing it out.
Of course.
Because it's all individual. It's segregated individual sub accounts. So it solves that problem as well, without having need for a license. That was a problem, right? Because if you had one trustee, if you had one US trustee, then you'd have no way of being able to keep the Grantor Trust as holder in due course. It would invalidate the filings. If you had a separate trustee outside the US, you couldn't get US bank accounts.
Nope.
And you therefore couldn't receive the ACH and Fedwire. If you were somehow able to set it up in some other country, that like in Puerto Rico or somewhere, because they have got ACH and Fedwire in Puerto Rico, then you'd be caught by the money services business, and you need a license to do that. So the Wyoming structure ticks all of the boxes, and it doesn't need any license to do it because it's under agency. It's all about agency. It's all about the operating as attorney in fact. And all these people going on about, oh, Ian set up a law firm. It's not a law firm. You know, he's pretending he's a law firm. It's like, really? No, it's an attorney in fact. It's to do with recoupment, actually. And if we don't have it, you won't get your recoupments, by the way. It's an attorney in fact. Agency. That's what it's about.
Well, to me, it's all about holder in due course. It's all about the 98 Grantor Trust. And love it or hate it, it's also about agency. We've spoken about this before, that it is a blessing and a curse. You know, we have a lot of members asking questions about how do I completely, you know, remove myself from agency? How do I sever the ties between myself as the living man, woman, and the birth certificate construct? And what we're saying is, why would you want to do that? Just play the game better. You know, just take the benefits that agency offers you, use the right structures. Yes, absolutely. Make those declarations of envoy status and just correct that side of things. Become the the general executor of the office of the general executor. Sorry, and just correct that side of things. But ultimately, if we didn't have that agency, none of what you've put together here would even work. It wouldn't even be possible. So for me, for my family, I know this is going to be life-changing, as I'm sure it is for many others. And then we can focus on what's really important, which is the freedom plan and looking at the bigger picture, the bigger infrastructure. But, you know, I hope that if you're watching this right now, I hope you can just see just a small glimpse of the research that Ian's done and the technical detail that he's put, the hours and hours and hours that he's put into this to make sure that this works. And I've got every confidence that we're going to see recoupment coming in, and that will be an annual thing, that we'll just do it as a matter of course, year on year on year, until such time as maybe we can't do it anymore. Who knows what the future brings? But I think for now, we want to be able to benefit from this. We want to be able to be smart with what we do with it. And we want to have that ultimate goal of freedom in mind. That's how I would, that's what I see with this architecture that you've put together, Ian. So I appreciate it. I hope you guys appreciate the fact that we've given you a 2-hour breakdown on all of the moving parts to this, not just Ian's, but also all the other moving parts that go along with this, the IRS and everything in between. Any final words before we finish today's interview, Ian?
Well, I just want people to, to realise, so I don't think very many do, that the reason why you don't see this signature credit being offered by loads and loads of organisations all over the world is because it's quite difficult. It's not easy to put all this together. It's not easy to understand it, and then it's even more. Once you understand it, then you've got to build it. Yeah. And it's quite complicated, as you can start to see. I mean, we haven't even gone into the full depths of the technical side of it. We've touched the surface, but this, for those people who might be thinking, well, I've never heard of it before, surely it can't work because no one else is doing it. Well, it's classic Ian, you see. This is what I've done my whole career. I do stuff that other people don't do, because either they don't understand it or it's too complicated and too difficult. And that's what I do. I'm a perfect fit for this. It's right down my street. Give me something difficult that no one's done before, and I want to do it. And that's why I think the cabal is a bit concerned about me and has been for a long time, because I do stuff that other people don't take on. And this is a very good example of it. There's a reason why no one else has been doing it properly, because they either don't understand it or they do understand it and it's a bit too difficult to pull it off. And that's why, if you've ever wondered Why can't I choose from one? Let's go in the directory and choose 10 organizations that offer this, and we'll pick the one we like. There's no one else doing this because it's complicated and most people wouldn't know how to build it, I don't think.
Well, guys, I hope you've enjoyed today's interview. I've certainly enjoyed the technicalities behind it. It's been an in-depth one for sure. And if you want to have a further look into this, then the Treatise report will be on the Ecclesia Law website. So you can go to ecclesialaw.is. You'll be able to see it on there. It's a big one, but it's certainly worth a read, even if you just break it down piece by piece. I think it's vital that if you are with us here at the Republic of Old Souls, if you're going through the processes and the protocols that we have here, you do have an understanding of how they work. I'm not expecting you to be the one to administer them. You know, we're prepared. We've got a filing team. We do the administration work for you, but you need to know how it works. And certainly I find it interesting to understand just the machinery behind how all this comes together. And if you do understand how it works, I guarantee you it will give you a lot more confidence in the process itself. Nothing this complex comes about by chance. It comes about by hard work and effort and research and verifying. We've talked about case precedent today as well to do with the 98 Grantor trusts. There's nothing missing from this protocol. There really isn't. So I'm excited about what the future holds. I hope you are too. And I look forward, as I'm sure Ian does, to seeing you guys on the next episode. We'll be covering other subjects. We'll be covering other protocols. We've got the avatar that's launching very soon as well. Lots of exciting things ahead of us. So have a great day, and we will see you on the next episode. Bye for now.